Have you ever watched a stock hit a ceiling, bounce around, and then suddenly explode upwards, leaving you behind? You probably missed one of the most powerful signals in technical analysis, the ascending triangle. This isn't just a random shape. The ascending triangle is a specific psychological battle where buyers are getting aggressive and sellers are slowly running out of steam. It is a classic continuation pattern that tells us the trend is stalling, but it's likely about to resume. In this video, I'm going to show you exactly how to draw it, but more importantly, I'm going to show you the one secret confirmation indicator that separates a fake out from a real breakout: volume. It is a classic continuation pattern, meaning if the trend was going up before, this pattern tells us it's just taking a breather before the next big leg up. In this video, I'm going to show you how to identify it, the psychology behind it, and the one crucial confirmation signal you must see before you enter a trade. Let's dive into the charts. So, what does an ascending triangle actually look like? Think of it as a right-angled triangle forming in the middle of an uptrend. It needs two specific walls to build the pressure. First, look at the top. You have a horizontal resistance line. This is formed when the price tries to break through a certain level multiple times, hitting a ceiling and getting rejected back down. The highs are flat. Second, look at the bottom. Here, the price is making higher lows. Every time the price dips, buyers step in a little bit sooner and a little bit higher than the last time. This forms an upward sloping support line. When you connect these two lines, you see the price getting squeezed into a tighter and tighter corner. The flat top means sellers are stubborn at that price, but the rising bottom means buyers are getting more aggressive. Something has to give. Before we talk about where to click buy, you need to understand why this works. Remember, this is usually a continuation pattern. The market was already in an uptrend. It's just consolidating, taking a pause. The rising lows tell us the bulls are still in control and are slowly absorbing all the sell orders at that top resistance level. But here's the pro tip that beginners miss. You have to look at volume to confirm the pattern. As the price bounces inside the triangle, getting squeezed tighter, trading volume should decrease. The market is getting quiet. It's the calm before the storm. The signal to trade is when the price breaks above that flat resistance line. Crucially, this breakout must happen on high volume. A big spike in volume tells us the smart money has stepped in and smashed through that ceiling. If it breaks out on low volume, be careful. It's often a fake out. Okay, so how do we trade it? Rule number 1. Don't anticipate. Wait for a candle to actually close above that resistance line. That is your entry signal. Where do you put your stop loss? A common technique is to place it just below the most recent higher-low swing within the triangle. If the price drops back below that, the pattern has failed. A final word of warning, and the text in our source material mentions this too. While the ascending triangle usually breaks upward, it doesn't always happen. If the price breaks below the bottom trend line instead of the top one, the pattern is void. In fact, it might signal the start of a reversal to a downtrend. That's why we always wait for confirmation and use a stop loss. Mastering the ascending triangle gives you a massive edge because you aren't guessing. You are reading market psychology and waiting for volume confirmation. If you found this breakdown helpful, smash the like button so I know to make more videos on chart patterns. Subscribe to the channel, and happy trading!